The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Defying the chaos, U.S. equities look to lock in their best quarter in more than a year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Who would have thunk it back in early April?
I know. Well, a lot of people didn't, and a lot of people missed out.
Exactly. So let's get a check on where markets stand right now. You have the S&P 500 set to close out the month, the second quarter, and the first half at a record high. For today, you have financials and technology shares leading the advance. We're seeing yields come down across the curve. The 10-year yield now down to 4.22%. The dollar is lower, which has been the story all month long. In fact, we're looking at a biggest monthly drop for the dollar since 2017. And NYMEX crude down 0.8%, now trading below $65 a barrel, slumping on speculation that there's going to be supply increases from OPEC plus. Romaine?
All right, and as the sun sets on the first half of the year, the Wall Street prognosticators have decidedly turned bullish amid a more risk-on move that pushes the S&P to, yes, a record high just a couple of weeks ahead of the next earnings season. And frankly, there are a lot of reasons to be optimistic out there, including progress on trade deals, progress on the 2017 tax cut extensions, progress on calmer geopolitical tensions, all creating more stable economic footing.
It's the economy. It's a good economy. It's been a resilient economy, number one. Number two, we're starting to see deals. So you look at a Goldman Sachs, deals mean profits for them.
And adding to the optimism is a Fed that at least is starting to talk about potential rate cuts. Bond traders have bought into that tone shift, pushing treasuries on a price basis to their best start to a year since 2020. And Treasury Secretary Scott Bessent aiding the moves today by suggesting he's not interested in adding long-term debt at these elevated rates, which, of course, would provide some relief when it comes to those supply concerns. However, while some strategists are starting to whisper the word Goldilocks, JP Morgan strategists say beware. Stocks could come under pressure if those rate cuts are accompanied by weaker economic growth. And analysts, well, for now, they're still standing by expectations for a sharp slowdown in U.S. profit growth, particularly, Scarlett, for those companies with heavy exposure to tariffs.
Yeah, but it feels like they've been standing by for that for a long time, and it hasn't come to fruition just yet. Now, speaking of rate cuts, let's look at the positioning. The vertical bars here show bond investors' bets on Fed rate cuts. Currently, 2 to 3 cuts this year. Back in April, they anticipated something like 4 cuts. That was shortly after President Trump unveiled his reciprocal tariffs, stoking fears of inflation. And you can see the Atlanta Fed's running estimate of real GDP growth, that is the yellow line here, bumping along the bottom here as well. That line has since recovered as Trump paused the tariffs and dialed down trade tensions with China. But now that the GDP now forecast has kind of rolled over a little bit, you can see that the number of expected rate cuts are picking up as well. Romaine?
As we kick you off to the close here on the final trading day of the quarter, let's bring Jerome Schneider into the conversation, Managing Director and Head of Short-Term Portfolio Management and Funding at PIMCO. Jerome, great to have you here in Studio 2. We wrap up a quarter and really a first half to the year that I think defied a lot of expectations. And now we're heading into a second half where there are big expectations when it comes to the budget bill in Congress, when it comes to the Fed potentially cutting rates, and just overall some semblance of economic stability, if not necessarily resilience. You buy into that narrative?
That's the hope. I mean, I think we can sit here at quarter end and through the first half of the year, recognizing that we've had a volatile first part of the year. And I think one of the things we have to reflect on is that volatility will persist for some time. So just because we have a calendar break, so to speak, doesn't mean that we go and continue to accentuate that lack of volatility for the remainder of the year. In fact, there's plenty of political discussions going on. Clearly, the debt outlook is not something that is going to be satisfied or remedied any time in the near future. And from our perspective at PIMCO, one of the main concerns which prevailed at the beginning of this tariff discussion still exists, which is inflationary outlooks. And that inflationary outlook is the key tenet for why the Fed may or may not cut. It's a key tenet why stocks might persist on an evaluation basis. It's also the key tenet why we see a steepening in the yield curve, which is steepened by 30 basis points over the past quarter alone. there's factors in here where inflation will continue to dominate the topic for the time being. So yes, we can take a sigh of relief for the moment, but there's a lot coming in the coming quarters.
But when you talk about inflation, what are we talking about? A reacceleration in the inflation in the inflation rates where we're at right now?
There's some expectations that inflation will continue to move higher. We expect that core PCE will move higher to about 3.1% by the end of this year. CPI, on the other hand, will go to 3.5%. That natural wedge that's in there. For that perspective, we're not anywhere close near that Fed target. And so while there's discussions, romantic ideas that the Fed's going to get cut by 5-6 times over the course of the next calendar year, the reality is in the immediate future is probably off the table, at least in July, maybe not until later this year, where we see an inclination where that slower growth mechanic translates into an actual rate cut at that point in time.
Yeah, unless we get job data later on this week that really shows deterioration. Could this jobs report that's coming up on Thursday be a make or break kind of report?
It will help shape the conversation. And again, there's two components to this, jobs and inflation. The jobs component, we do expect weaker jobs. We're forecasting less than 100,000 job creation, and that unemployment rate is going to go up to 4.3%. But as any economist will note, we're focusing on the trend. And you still have job creation going on. We're not seeing a drastic reduction in jobs. We're not seeing mass firings. We are seeing a lower growth outlook that's sub 1%. That's something to potentially be concerned with if it shows further deterioration. But in the immediate sense, there's not a concern for immediate action of monetary policy to ease. And I think that's one of the things where the market and perhaps the market pricing are dislocating in the immediate sense. In the long-term sense, there's a lot of perspective here where there is some higher yields. We are seeing some concerns about inflation out the curve, more supply as people as the Treasury in the U.S. need to finance their deficit. Those are all concerns that are going to have focus on the shape of the yield curve. But in the immediate sense, we are finding some relative attraction in the mid parts of the yield curve, the 5-year point to be exact, where you are able to get good nominal returns and good real inflation-adjusted returns right now in a diversified portfolio. Mm-hmm. And combined with a potential outlook for volatility, when we're thinking about fragmentation, differentiation, there's good opportunities to take advantage in the fixed income markets.
The 2 and the 10-year are now trading at about 2-month lows when you look at the yield. And we've seen this huge roller coaster ride for the 10-year yield so far this year, up as high as 4.79%, up down as low as 3.99%. What is not priced in? Because that's a huge range.
Yeah, I mean, we're sort of at that midpoint in the 420s.
Yeah.
And I would say that what's not priced in is a severe recession. So that's on the downside. What's not priced in on the other side is potential stabilization of the employment outlook, or more importantly, not as many decreases in employment outlook at that point in time. And secondly, inflation. Inflation, more persistent over the longer term, will not necessarily be oriented to monetary policy, meaning monetary policy might cut itself, but investors are going to have to think about what the proper term premium is to buy those assets, especially the 10-year and the 30-year points on the curve, that they're compensated enough to take advantage of that. So from our perspective, there's a longer-term discussion going on than the minutia of what happens at the July Fed meeting. Is a discussion of where are term premiums, where's inflation outlook, and put that in the context of risk pricing that we see in equity markets and credit markets at this point in time, which is a little bit concerning at this point in time. So yes, we end the quarter and then in the first half of the year in a very nice place from that perspective, but in the longer term, those instruments of volatility might persist, and we urge investors to be more oriented toward income-oriented type of investments in that regard.
All right, Jerome, always love it. A great conversation, as always, with Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding at PIMCO, kicking us off to the close here on this Monday afternoon. When we come back, a conversation with the CEO of Robinhood, Vlad Tenev, fresh off the stage at the company's first ever crypto keynote in Cannes, France. That's coming up in a second, right here on Bloomberg.
Robinhood shares are trading at record highs after the brokerage introduced a suite of new products at its first ever international and crypto-focused event in the south of France. Let's bring in now Robinhood CEO and co-founder Vlad Tenev, who joins us now from Cannes. Vlad, you are now offering tokenized U.S. securities to customers outside the U.S., particularly in Europe, where you are. How is this different from exchange-traded products that are already available to investors in Europe? What do the tokenized versions of these products offer that existing products don't?
Yeah, I mean, what we really announced in the EU is first, we're expanding and we're live now in 31 countries across the continent. And we're solving two things with our stock tokens. One is giving our EU customers exposure to U.S. equities, which is one of the most requested features. The second is really demonstrating the beginnings of what we believe is the future of the financial system. We think that crypto and traditional finance will eventually fully merge, and the technology will underpin any tradable asset. And you'll get the liquidity and the 24/7 trading of cryptocurrency applied to traditional assets, which I think is a very powerful thing. It's useful for public stocks and also private stocks, which we have the ability to tokenize as well.
Now, you're developing your own blockchain to record transactions for tokenized stocks. What's the timeline for that to be rolled out?
Yeah, that's right. Well, it's live today on Arbitrum. So we've been working with the folks on Arbitrum, which is an Ethereum layer 2, for the initial release of our stock tokens in Europe. But we have been working on our own chain, the Robinhood chain, and we've been hard at work. We'd like to have that powering the underlying infrastructure and all the DeFi elements. We want it to be the best chain optimized for real-world assets, which I think is an important niche that's missing in the market. And for that, it has to be secure, basically military-grade security. It has to be fast, low cost. So we felt like that didn't really exist. And so we're excited to bring that to market.
I am curious, Vlad, about the idea of staking, particularly here in the U.S., obviously a program, I believe, starting today, if I have that correct, and also certainly some appetite for that amongst European investors. And I'm wondering how, if at all, those two elements in the U.S. and Europe would differ or be the same.
Yeah, I mean, we announced a lot of new products. You mentioned staking, which has been live in the European Union for our customers here for many months. And it's actually been the #1 most requested feature in the US. So now that's live. And I think it's two things that are interesting for staking. One is, from a practical standpoint, it allows holders in the US to earn yield on their Ethereum and Solana, and expanding to hopefully any stakeable asset in the future. But also, crypto is all about us coming together individually and collectively to secure the network and the blockchain. So the participant, the individual, is really the network, and staking allows that to be opened up to the millions of customers on Robinhood. So that's what makes it so exciting for us.
I am curious, as we start to see this ecosystem, the broader crypto ecosystem, evolve and, more importantly, expand, and you kind of pointed out in your previous response, this idea that sort of the DeFi world and the traditional finance world are starting to overlap in that Venn diagram. And I am curious as to what your ambitions are for Robinhood. Is this more of a move, of a shift, where that Venn diagram for Robinhood looks more like traditional finance, or something in between?
Yeah, two things. One is, I think this is the year and the time is now for crypto to move beyond Bitcoin and meme coins and introduce fundamental utility. And that's why we're most excited about tokenization of real-world assets with utility, being live on blockchains, and getting the benefit from everything that crypto technology has to offer. That's one. Two, we think in the future, crypto and traditional financial services will fully merge, and crypto will become the infrastructure layer behind all kinds of financial services, from payments, which you're starting to see with stable coins, to holding deposits, which has been the realm of traditional checking and savings accounts. So you'll have stable coins that pay interest in the future, including USDG, which is the stablecoin that we've helped create. And then, of course, investments with tokenized private shares, equity stock tokens as well. What you're starting to see is the entire financial system being possible to build on crypto technology. And, you know, what we can do is show what the world looks like if we rebuild Robinhood entirely on crypto technology. And I think that's what we're starting to demonstrate.
Vlad, let's take a little bit of a step back here because you have talked about how the U.S. is finally ready to catch up to the rest of the world when it comes to being a big player in the crypto world. But what needs to happen? What's the missing ingredient now for the U.S. to become the true backbone of the global financial system when it comes to incorporating crypto?
Yeah, I think the bills that are making their way through Congress, the Genius Bill and the Market Structure Bill, are a great step in the right direction. As for tokenization, we actually believe that there doesn't need to be additional legislation. The SEC has the mandate, the authority to make tokenization of securities happen. And they're keen to do it. You know, they posted a roundtable. Our crypto GM, Johan, was a part of it on tokenization. And I think that it's going to happen in the not too distant future. Private companies require reform of the accreditation standards, which currently shut 80+% of the population out. So that needs to be completely reformed. But there's actually appetite. Several members of Congress are interested in taking that on. And I believe we can make significant progress on reforming the accreditation standards as well. It's crazy that, you know, these companies like OpenAI and SpaceX can be worth hundreds of billions, can get so much appreciation in the private markets, and retail is essentially shut out from that. So that's something that we'd like to fix with our technology as well.
All right, well, you guys have already made a lot of progress toward that. Vlad, really appreciate you taking the time. Also love the suit there. I will let you get back to it fresh off the stage.
Thank you.
There in France, the CEO of Robinhood. And just a reminder for our viewers, a full hour-long conversation with Vlad Tenev. That's actually going to be released tomorrow. We had a chance to sit down with Joe Weisenthal and Tracy Alloway for the Odd Lots podcast. That's going to be released to the public at 4 a.m. tomorrow, Tuesday. You can get that on your terminal, wherever podcasts are sold. All right, we are going to keep it moving here with a focus on tech. When we come back, a conversation with Stefan Slowinski over at BNP Paribas EXANE. Let's get right to it. Top calls, big movers on the back of analyst recommendations, and we start with Disney. Jefferies upgrading to buy, lifting the price target to 144. The analysts expecting a, quote, earnings breakout with a favorable pipeline of movies on the slate. The shares up about 1% on the day. Next up, McDonald's, KeyBank trimming its price target to 325 from 340. The firm sees the fast food chain's growth slowing as competition remains strong. Those shares nevertheless getting a modest bid on the day. And finally, let's take a look at Oracle. Stifel upgrading today to buy, boosting the price target to a street high 250, with the analysts saying the acceleration of Oracle's cloud business is sustainable and should offset concern about an equally dramatic acceleration in capital expenditures. Those shares moving up 5% on the day to a record high. We should also point out that earlier today we did learn from Oracle about a single cloud deal worth $3 billion in annual revenue without it naming the company. We should point out that Oracle has been retrofitting its 5-decade-old data business to the cloud, and it has gotten a massive boost, of course, from the massive investments in AI, emerging as a reliable, fast-growing alternative to Amazon. In fact, BNP Paribas EXANE upgraded Amazon last week to outperform, though the analysts did express some concern about near record highs for CapEx spending at the big four hyperscalers, which also includes Alphabet, Meta, and Microsoft. Stefan Slowinski joins us right now, global head of software research over at BNP Paribas EXANE. And let's start off here with this broader ecosystem in AI. We've seen it benefit Oracle. We had an announcement earlier today about how Meta and Mark Zuckerberg is sort of reimagining, I guess, his sort of inner cohort of advisors to really focus on AI. And of course, we've seen the phenomenal growth out of Amazon, out of Microsoft, and more importantly, out of Alphabet. Does that continue, Stefan?
Yeah, hi, Romain. Thanks for having me. And yeah, absolutely. We think we're on the cusp of another AI acceleration. So we're seeing various different signals. OpenAI hitting $10 billion of ARR has obviously woken up the competition even more. We think OpenAI and Microsoft renegotiating that relationship is another catalyst. That should allow OpenAI to get those SoftBank funds to create Stargate and to start spending. We've got Elon Musk and xAI spending quite a lot. And as you mentioned, Meta as well today launching their superintelligence AI group, trying to catch up on the large language model front after some disappointments with Llama. So we don't see things slowing down. We see them accelerating. That's why we published some work at BNP Paribas EXANE last week on the hyperscalers, but also looking at the other side of the equation, which is maybe the less glamorous side around, depreciation schedules, OPEX cuts that may be required to protect margins, and eventually near-term earnings growth.
Well, it's interesting because we're now talking about companies that for years didn't have as much of a physical asset presence, and that was a net positive. As they move deeper into this space, you upgraded Amazon, downgraded Alphabet, and I am curious why there's a divergence there. Are they not both facing the same depreciation issues?
They are, but I think you need to look for companies where revenue growth is going to accelerate and where Gen AI can add to revenues in the near term. So when you look at Amazon, for example, you have around 27% of sales coming from AWS and their advertising business. And so that's growing in the high teens, maybe 20% soon. So that's going to be pulling up revenue growth at Amazon. We also think Amazon Web Services is set to join Microsoft and Oracle at that AI infrastructure party. So Amazon Web Services has been a bit quiet thus far on the AI front. They do have the 3 Cs coming. They have capacity coming online. They've got chips with their Trainium 3 chips ramping into next year. And then you also have Claude, which is their relationship with Anthropic and those models. So we think that AWS is big enough to drag up growth for Amazon. For Google, they do have Google Cloud Platform, their enterprise cloud business. It's only 12% of sales, so it's not big enough just yet to pull up group revenue growth. And of course, you still have some business model transitions to come on the search side, which could impact growth there. So we actually see the depreciation weighing a bit more on Google and maybe more on earnings growth near term, whereas Amazon should still be able to give you that mid-teens earnings growth and hold that multiple steady.
Stefan, where does Meta fit into all of this? Romain talked about how it's trying to hire a lot of people. It's planning to spend hundreds of billions of dollars on AI projects and research as well as personnel. But you have an underperform rating on this stock. Does this move you in the direction of perhaps thinking about upgrading it?
No, it doesn't. So I think we like all of the hyperscalers long term. I think they all benefit from capacity, compute, data, models, billions of users. So long term, that's good for all of them. I think near term, when you look at Meta, they don't have an enterprise cloud computing business like Amazon does, like Microsoft does, like Oracle does, like Google does. So they won't see that near-term benefit from that pickup. It is still 98% reliant on advertising, so they'll need to use Gen AI to drive advertising growth, which we think they will over time, but that will take some time. And obviously on the flip side, you have the spending. So whereas Microsoft and Amazon are all signaling headcount control, cost cutting, margin preservation, we're seeing Meta actually go in the opposite direction. 80% growth year over year in CapEx, 22% growth guidance this year in OPEX, and that was even before the superintelligence unit has been formed.
All right, Stefan, really appreciate your joining us. Stefan Slowinski is Global Head of Software Research at BNP Paribas EXANE. Coming up, we'll speak to Kent Smetters, Faculty Director of UPenn's Wharton Budget Model, to discuss the economic implications of the Big Beautiful Bill. This is The Close on Bloomberg.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like.
Treasury Secretary Scott Bessent there on Bloomberg's Open Interest team today expressing his confidence in the president's tax bill. But our next guest warns that the legislation could have some steep economic implications, starting with increasing the federal debt by almost 10% in 10 years. Joining us now is Kent Smetters. He is Faculty Director of University of Pennsylvania's Wharton Budget Model. Kent, thank you for joining us. We know Senate Republicans are moving forward with an accounting maneuver that would allow them to make the case that extending the tax cuts won't cost anything. What is this current policy method that they're citing?
Right. So the House basically said that the tax bill is going to cost about $2.4 trillion. The Senate wants to get that number higher in the sense that they want to make a lot of the parts in the House bill, especially in the business side taxes, to be permanent, but they want to obfuscate the costs. And how they do that is basically saying, you know what, lots of those tax deductions and reductions are already in law. So therefore, even though they're going to expire at the end of this year, if we renew them for next year, because they're current policy for this year, we're going to pretend like there's no cost. It's kind of like having a magazine subscription that expires at the end of this year and saying, you know what, I'm going to extend it next year. It's going to cost me nothing because I already get the magazine this year.
Yeah, some Democrats are calling it magic math. If it is allowed, what kind of precedent does this set?
Oh, my goodness. I mean, two sides can play that game. In particular, certainly Republicans can do it right now for tax cuts. But Democrats, if they ever take majority again, they could do the same thing for spending programs. For example, you could have an enhanced child tax credit for just 1 year. And that can be pretty expensive. I mean, during the Inflation Reduction Act, for example, 1 year of enhanced child tax credit costs almost $250 billion. So during that year, then you pass another piece of legislation that says we want it for another 10 years. But because we currently have it this year, we're going to pretend like the next 10 years are just free. And so you would essentially hide $2.5 trillion that way.
All right, Kent, well, let's stop pretending and let's just assume these numbers are what they are at face value, which is additive, right, of course, to the deficit. I am curious about the tax cutting side of this, the potential promise, or the promise at least that Republicans are making for an economic boost, and whether that economic boost could potentially account for and maybe exceed whatever hit we get on the deficit side.
Right. The simple answer is no. It won't even come close. First of all, it's not going to come close to paying for this current bill because even the tax incentives that are on the business side are not only a small piece of it, there's just not enough juice there to pay for this much more expensive bill relative to, the original Tax Cuts and Jobs Act. And secondly, there's definitely not going to be money left over to pay for other debt reduction. Right now, under current law, even without this bill, we're on this exploding path of debt. And so the Republicans have argued that not only could this be a complete freebie unto itself, but maybe we'll have money left over to bring down some of that other debt. And the answer is it's not going to even pay for itself, not even remotely. It literally, when you do a dynamic score, both we and the CBO, when we did on the House side, we found that the dynamic score, even though there's small positive economic growth, the dynamic score is even higher than the conventional score, and for various reasons. And so there's no way this thing's going to come close to paying for itself, and there's certainly not going to be money left over.
Well, this is what I'm curious about, Ken, and you guys are doing some great work over there at Penn Wharton, and of course you spent some time at the CBO. You also spent some time at the Treasury, and I want to ask your perspective as to how the Treasury Department handles this, assuming that it is passed basically as we know it's written. And the reason why I ask is because at the end of the day, the Treasury cannot necessarily operate in hypotheticals or operate in the idea that some of these costs are hidden. They have to deal with the actual dollars and cents flowing in and out, for lack of a better analogy. And I am curious as to what advice you would sort of counsel the Treasury Secretary in sort of managing that over the next few years.
Sure. I mean, it's a great question because the Treasury auctions, how much they have to auction in terms of new debt to pay for this bill, is going to be independent of how we label the bill, relative to current law or current policy. They're going to have to issue new debt relative to current law, plus all the rollover debt, which is another $9 trillion that comes due this upcoming year. And so, Treasury is going to have to make certain commitments to the bond market. It's the bond market that is the real disciplinary device here. The bond market, do you want to have a Liz Truss moment, or do you want to have a more smooth auction? Do we want to have an April 2nd type moment, or do we want to have a much more smooth process? And so there has to be, after this bill is signed, other language that comes out saying that we are really committed to dealing with some of the long-term problems, both in the entitlement programs that have exploding costs, as well as even fundamental tax reform. And granted, some of those things can't be handled right now inside of the current reconciliation process due to what's called the Byrd Rule. But nonetheless, Treasury has to signal to capital markets that this administration is serious about taking this exploding debt under control. Because if they fail to do that, the Liz Truss moment can happen in the United States. And we already saw some hints of that on April 2nd with the tariff announcements with lots of, capital fleeing, dollar falling, and so forth. Mm-hmm. So it is something for us to take really seriously going forward.
All right, Kent, we have to leave it there. Kent Smetters, Faculty Director of the University of Pennsylvania's Wharton Budget Model, as we await a potential Senate vote here on that big, beautiful tax bill working its way through Congress. And right now, at least one Republican defection, only two left before you would need a tiebreaker from J.D. Vance. When we come back after the break, we're going to refocus our attention on AI. Apple shares now at session highs, up about 3% on maybe a potential pivot in the AI space, and also seeing strength elsewhere in that space as the build-out continues. And one potential beneficiary of that is a private company, Commonwealth Fusion Technology. We're going to talk to the CEO and co-founder when we come back after the break. This is Bloomberg. All right, welcome back. The only thing hotter than AI is the energy needed to power it all. We just learned earlier today that Alphabet's Google has agreed to purchase 200 megawatts of power from a company called Commonwealth Fusion Systems. They're building their first commercial plant and it's set to go live in the 2030s. Joining us right now is the CEO, Bob Mudguard. Bob, great to have you here on the program. Let's first talk about the technology that you use and just kind of give me the layman's explanation. When we talk about fusion technology and magnets, a lot of talk about magnets lately. Tell me exactly how this works.
So in traditional, like nuclear power, we split the atom. Everyone knows how that works, and we've been doing that for a long time. But in fusion, you combine the atom, and that's what happens inside the sun. But in order to make that work, you have to create the same conditions inside the sun here on Earth. And so what we develop is we develop types of machines that create those conditions using very strong magnetic fields to heat up tiny, tiny bits of amount of fuel to very, very high temperatures. And at that point, it reacts and it produces a huge amount of power, a type of power that you can only get from like a big coal or nuclear power plant. But in this case, using a completely different process and a completely different fuel.
All right, you guys have been working on this for a while. We should point out you guys are basically a spinoff out of MIT, Massachusetts Institute of Technology, $2 billion in funding raised so far. I am curious about the persistence of the energy source, the idea that it will be reliable and it will be consistent. Is that something you can guarantee a Google or any customer that comes along?
Well, we know that the fusion energy is pretty reliable because the sun is very reliable, right? This is an energy process that can sit there and make power just continuously, provided that you have the right conditions. And so what we have to do here on Earth and in our machines is we have to create those steady conditions. And we're building a machine outside of MIT, down the road in Massachusetts, that's designed to show that you can do that you can actually make a large amount of fusion energy at more times power out over in reliably over and over again. And that's building off of this scientific history that's been done at national labs and universities for a long time. The next step is to go to a commercial power plant, and that's the one that we just announced with Google in Virginia. And that would be a large amount of power, about 400 megawatts, and Google's going to take half of that power, that would be able to be run like a traditional coal or nuclear power plant, when you want it, not dependent on the sun or the wind. And that steady base load power is really important for the consumers.
Bob, we know that the president is looking to push nuclear energy. He's signed a couple of executive orders to really boost nuclear energy production in the next 25 years. Is that good news or bad news for fusion energy providers like yourself?
It's good. Fusion and fission, they're the opposite process, But the end result is you get a lot of power in something that you can control and that you can put where you want it. And so, the president's agenda of energy dominance and leaning into next generation technologies that could be, the cornerstone of, deeply sovereign energy, that's a really big deal. And for fusion, we've already seen indications that it's a top priority for the Department of Energy, and various funding programs are part of the bill and are moving forward.
And give us a sense of the size and scope of fusion energy versus nuclear energy. How stark is that contrast?
They are similar in many ways. In both cases, you're building a plant. You show up and you build a plant. But in fusion, you don't have any uranium or plutonium, and the problems that come with, what are you doing with that uranium, plutonium, and the potential meltdown or runaway reactions or long-lived waste. And fusion doesn't have any of those, and so in some ways, it's a bit simpler than traditional nuclear power. But at the end of the day, it's about building a plant that doesn't need a lot of fuel, a plant that you can run when you want to run it, and you can build it where you want to build it.
All right, good stuff. Commonwealth Fusion Systems CEO and co-founder Bob Mudguard on the heels of that deal with Google. And of course, Romain, one thing that's worth noting here is that the company is backed by Bill Gates' technology fund, Breakthrough Energy Ventures.
Yeah, I mean, this fund has there's a company, I should say, has a great pedigree when you look at not only who the founders were, where it came from, but also the backers of it. And it gets to this idea, too. I mean, we were talking with Stefan Slowinski, and he was basically saying, look, this AI trend is going to keep going and going. We're looking now at Apple up almost 3% on the day, simply because maybe they finally found a pivot into AI.
Well, they're going to outsource it. They're not going to do it themselves.
Yeah, well, they try to do it themselves, and you see where that
They spent a lot of money and didn't get very far.
I'm still waiting on the answer, Siri.
Coming up, we're going to count you down to the closing bells with Megan Horeman, CIO at Verdence Capital Advisors. This is The Close on Bloomberg.
We expect that core PCE will move higher to about 3.1% by the end of this year. PCE or CPI, on the other hand, will go to 3.5%. That natural wedge that's in there. For that perspective, we're not anywhere close near that Fed target.
PIMCO's Jerome Schneider on the economic backdrop heading into the second half of the year. As we wrap up the first half, Romain Bostic alongside Scarlett Fu. Just about 10 minutes until we get to those closing bells, Scarlett, as we close out the quarter, and it has been a phenomenal quarter, particularly in light of all the chaos that we had coming into it.
Absolutely. Early April was a disaster for anyone who's long equities, taken by surprise by those reciprocal tariffs. But we've come back, and the S&P 500 finishing the first half up 5.5%, but pales in comparison to global stocks.
Yeah, it pales in comparison to global stocks, and we talk about that outperformance that we had seen, particularly at the start of the year. We should point out over the last few weeks, that's kind of flipped back into the U.S.'s favor. We'll see if that continues going forward. But you have to ask yourself, what exactly is the upside case, given that we're already at record highs? Most people on Wall Street are projecting a bit of a profit slump in corporate America. Most people on Wall Street are also projecting additional volatility. So what are we hanging our hats on?
Fed rate cut. Fed rate cut this
year. About that.
Yeah, and next year.
Does Jay Powell know that?
I think he's been told several times.
Trump's been tweeting about that this morning. So
he's been made aware.
All right. Well, in all seriousness, though, it does get to this idea here of a market that has found a way to look through a lot of the noise and chaos coming out of Washington, to look to corporate fundamentals, to look to a relatively stable economic environment, and maybe that's enough to propel this market further into the second half of the year. Megan Horeman joins us right now, CIO at Verdence Capital Advisors, counting us down to the closing bells. And Megan, we kind of joke a lot here about kind of what the next catalyst would be to propel this market. I understand, look, there are some big structural themes here, particularly with AI, that are really helping to fuel the enthusiasm here. Once you get past that, though, do you see a fundamental case for buying stocks, entering new positions, expanding on old positions, and not just the ones that are in that AI big tech ecosystem?
Yeah, at this point, with the indices sitting near record highs, as you mentioned, I'd be a little cautious, specifically on that U.S. large cap area of the market. I think it may be showing some signs of complacency given all of the risks that are out there in the market. So I would just be a little bit cautious here. Make sure that you understand your asset allocation, understanding if some of these different investments have actually risen above where you want that target rate, where you want that target allocation to be. You want to rebalance portfolios if that is happening, because I don't think that some of this volatility and negativity is behind us.
Absolutely, and we should point out, of course, we're already seeing that rebalancing take place right now, of course, for the big institutions and pension funds on this final day of the quarter. This gets to this idea, though, Megan, of if you haven't done that, if you sort of missed out on the rally or maybe you got stuck inside of it, is there a reason to significantly reallocate on a risk basis, meaning take risk off the table or put risk back on, depending on where you're starting from?
I'd hold tight where you are right now. I would, if you have that dry powder, which is what we've been recommending for the first half of this year, have some of that on the sidelines. Enter this market in gradual steps, and that's what we've been doing. But we've been kind of sitting tight right here, not selling into this rally, but making sure that we're allocated in the right appropriate way. Look at some of those things that are pricing in some of the downside risks. So while the large cap area in the U.S. has rallied significantly, and as we mentioned, sitting here at record highs, look at some of the small and mid-cap stocks. Now, these are economically sensitive, so if the economy continues to weaken, there could be some downside here, but these are in double digits off of their recent 52-week highs. So these are showing that there might be some of that risks baked into these prices. That's the area that we would look at. And then make sure that you're diversified from a global perspective. Make sure you have some of those international equities in your account as well, because they're going to add that extra layer of diversification. And we are seeing, as you mentioned, the first half of this year, some rotation into those international, specifically developed international equities.
You know, right now I'm looking at the indexes make another run towards new highs of the session, with the S&P 500 now up by 2/3% in the final minutes of trading here. Megan, we talk a lot about mechanical buying, you know, the technical driven buying that's taking place, at least in this latest leg of the rally that's put the S&P 500 in record high territory. Talk about where that leaves us in terms of earnings estimates, with companies set to report earnings in about 2 weeks' time.
Mm-hmm. So I think you mentioned it, this kind of mechanical type of trading. I also would call this momentum. And we have the AI trade coming back again now. So I think this is kind of that fear of missing out, the momentum trade. And they can be very dangerous, especially when we unfold some of this mechanical buying, as you mentioned, this quarter end type of rebalancing. This is where we then have to get to the fundamentals. And you mentioned earnings. Earnings season is coming up. We also have a couple deadlines, whether it's the tax bill or whether it's the tariffs that are coming due in July 9th. All of these things are still out there. We think that this can add to another layer of volatility as we go through the next few weeks.
How are you thinking about this week's jobs report, which a lot of people are hoping might open the door firmly to a rate cut in July?
I don't think that there's a rate cut in July. I still think it's way too early for the Fed to be able to see what's going on from a tariff perspective. The jobs report obviously will be very scrutinized, because if we get a significantly weaker jobs report, but remember, it can't just be that headline payroll addition or deletion. We have to look underneath of that. What does the unemployment rate do? What are the average hourly earnings do? Those are some of the things that the Fed's looking at from the labor side of the market, as well as the inflation. We think at the end of the day, the Fed, it's okay for them to be on pause here until that September meeting. Let's see what happens with the tariffs. Let's see how this unfolds into the inflation numbers, because some of the inflation numbers that we've been getting are really only from May. We aren't starting to see this pass on to consumers if that were to occur from the business perspective. And we have some tariffs in effect right now. So I think the Fed wants to wait and see how that goes through. Is it a one-time hit to inflation, or is this something that may be a bigger problem? They don't want to be in a stop-and-go monetary policy, and they don't also want to be too early and too dovish, because that can also reignite inflation, especially when you're looking, as you mentioned, some asset prices sitting here near a record high.
Megan, always appreciate it. Megan Horeman is the CIO over at Verdence Capital Advisors, counting us down to the closing bells here on this Monday afternoon, the final trading day for the month, the quarter, and closing out the first half of the year. I just want to point out real quickly, Scarlett, on a daily basis, because we're going to talk a lot about what happened over the quarter and the first half here. Robinhood out front, up about 13% right now, and that's been a big story over the last few weeks and months, the sort of re-emergence of crypto as an investable asset class, partly aided by policies coming out of Washington.
Yeah, record high for Robinhood, record high also for Oracle as well. So we're seeing a number of big cap stocks pick up these big gains in the final trading day of the second quarter and the first half. In fact, I look at the industry groups within the S&P 500, 8 out of the 11 groups finishing with big gains, with industrials and communications services, double-digit advances. And
you're seeing the S&P right now, right around session highs, and a big part of that is obviously the big lift that we're seeing out of Apple. The shares were unchanged earlier in this session. They're now up more than 2%. The idea that maybe it's going to find an AI strategy that's going to be outsourced. The full breakdown of all of today's market action, all of the months of market action, and all of the quarters starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Food, taking you through to that closing bell with a global simulcast. It starts right now. Carol Masser in the radio booth. Matt Miller filling in today for Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, as we close out the month and the quarter, Carol, on a relatively high note.
Yeah, I mean, so much bouncing around that we've seen in today's session, but fascinating to just watch what over the last hour, 45 minutes, we've seen, Matt, stocks really bounce to the upside. So we're going to, pretty much close at almost our highs of the session.
Yeah, and like I said, we saw that, and I'm sure you've been talking about Romaine as well. On Friday, after a brief drop, we had on your program, stocks closed at another record high. They shot up today. We're over 6,200 right now and have been to 6,205 at the intraday high. So not only do we have continuing, record after record on the NASDAQ, we're seeing it now in the S&P.
And of course, the next thing that's going to move markets is the jobs report later on this week, coming a day early because of the 4th of July holiday. And after that, we have earnings season once again. Have the estimates and the stock prices merged enough to not get a dramatic reaction?
And it's kind of interesting. We're actually seeing a lot of analysts out there actually start to downgrade their outlook for earnings. And that's kind of been the trend line before. It'll be interesting to see what those second quarter numbers say. But Carol, I do just want to point out real quickly, too, we are now also talking about a market, not just at record highs, but now heading into overbought territory with the RSI on the S&P above 70.
No, it's a really good perspective. You got to look at the valuations, right, in terms of where we are.
All right, as we get the closing bells here in New York, let's walk you through the numbers. A lot to parse with the S&P, the Dow, and the NASDAQ all in the green on the day. The NASDAQ 100 closing out at a fresh record high, up 0.6%. The NASDAQ composite up about 0.5 percentage point on the day, while the S&P 500 also adding about 0.5 percentage point on the day. And we should point out, on a quarterly basis, we're talking about gains of about 11% on the S&P 500 and about 18% on the NASDAQ. The Dow getting involved on the day and on the quarter as well, though its quarterly numbers only up by about 5% for the quarter. The Russell 2000 higher fractionally on the day, and for the quarter, it looks like it's going to log a gain of about 8%.
All right, to the S&P 500 back there I go. And Scarlett, you've got 348 names to the upside on this Monday, 154 losing some ground and 2 unchanged.
All right, let's take a look at the IMAP. And what it shows is that there are only 2 sectors that finished in the red. Consumer discretionary, led by the auto companies, down about 0.8%. Energy also down 0.6%. Meantime, you have technology, financials, and real estate investment trusts leading the advance.
All right, to the individual gainers. So HPE, guys, number one gainer in the S&P 500, a gain of 11% in today's session. The Justice Department settling its lawsuit challenging HPE's $13 billion takeover of Juniper Networks. So what they are going to require is that the combined company sells HPE's instant-on wireless networking business and auction off a license to Juniper's competing Mist business. Still has to be improved by a court, would negate the need for a trial that was set to start July 9th in San Jose, California. And the deal would have consolidated the sector from 3 major players to 2, controlling 70% of the market. But the settlement basically preserves competition in the global networking market. But nonetheless, investors cheering HPE. I should point out Juniper also doing well, up about 8.5%. Now I'm going to flip on over to Oracle. It was up as much as 8.5% in today's session, finishing the day with a gain of about 4%, rallying on news that it has signed a single cloud deal worth $30 billion in annual revenue, and it's expected to start flowing in fiscal year 2028. It did not name the customer, but the deal among the largest cloud contracts on record, and would represent nearly 3 times the size of its current infrastructure.
You know what I love about this? It said $30 billion annually, right?
Yeah.
So narrow it down. I mean, how many customers are out there that have $30 billion?
Gotta be one of the big dudes, right?
So
Yeah,
it's a list of about 5
Sounds
or 6.
like. Want to give a hint?
No, not on air.
Okay.
It's just gigantic.
It's gigantic.
Consider that Google was paying $20 billion a year to Apple, and that was already a mind-blowing figure to put Chrome front and center. So this, is 50% more than that, obviously. It's just huge.
Our Brody Ford said, unprecedented scale, unprecedented win for Oracle, but they're also going to have to spend big, right, to meet this, and build it out. So just keep that in mind.
Also, $30 billion
earnings.
at the deal that they're offering. I don't know if you listen to Bloomberg Radio very often, but
never listen.
If you sign up for
I do.
Oracle's web services now, switching from another provider, they'll give you 50% off. So it would be $60 billion a year.
I'm not sure if
They got a sweetener.
Okay. All right, I'm going to go to something a little bit different, a little bit nutty. Ticker is BMNR, Bitmine Immersion, and this one's soaring. It's a microcap Bitcoin miner announcing a $250 million private placement to fund an Ether treasury and named Thomas Lee, the founder of Fundstrat, as chairman of its board. So following in the likes of a model that we've seen by, we talked about this with Joe Weisenthal, a model created by Michael Saylor over at...
Love Tom Lee.
Yeah, exactly. Stock up 694% here in today's session.
Do you not love Tom Lee, Scarlett? I mean, he is a CNBC contributor, so
I'm just marveling at the share price jump from $4 and change to $34.
It's crazy, right?
Pretty remarkable.
It's kind of crazy. And I should point out, honorable mention, Apple up about 2% as it's considering maybe outside AI to help Siri.
People are happy that it's not going to spend more money on AI.
I know.
Trying to build its own AI.
Just buy it, right?
Here are the losers. Amazon.com. I'm not sure if this is why it's down, but I'm sure you've all seen the reporting that you can't get Nintendo's Switch 2 on Amazon.com, the U.S. site, because of a fight they had previously about selling unauthorized Nintendo games. Apparently, people were buying packs of Nintendo's games in Asia at a discount and then bringing them here to sell for cheap on the U.S. site. Now you can't find a Switch 2, which is like the biggest console launch of all time. They sold 3.5 million Switch 2s in the first 4 days, and they're looking to sell 15 million total. Tesla, you saw down as well. It had been up briefly in this morning's trade when I was anchoring Bloomberg Open Interest, which is weekdays from 9 a.m. to 11 a.m. on Bloomberg TV. So Elon Musk was out on Saturday slamming the one big, beautiful bill because it cuts the EV subsidies sooner than expected, or sooner than previously was planned. In September, you won't be able to get the $7,500 back if you buy a Tesla or some other EV. And then some smaller stocks, Chemed down after the hospice service provider saw weaker than expected Florida Medicare results in April and May. It's a much smaller, well, now even smaller, I think a $7.5 billion stock, CHE, the ticker. Fortive, FTV is about twice as big. That company down after management said second quarter revenue will be hurt by increased pricing pressure and lower demand. The company also completed separation of Precision Technologies segment as Ralliant Corp, which trades under a separate ticker, RAL. So a couple of little movers there, but I thought the big ones were more interesting, actually.
All right, I'll add another mover to the pile here in after-hours trade. Shares of Boeing fractionally lower. This after announcing that they are going to implement a new CFO. Brian West, who's been in the job for a little less than 4 years, going to be stepping aside. And Jay Malavy, who had been the CFO over at Lockheed Martin up until about April, will be taking on that role. Of course, Kelly Ortberg, relatively new CEO at Boeing, has been trying to reshape things and get this company and, more importantly, the stock back on track. But again, the headline, a new CFO at Boeing. All right, let's check in on yields for just 1 second here. We did see them move down, as that, of course, has been the trend line for the past few weeks, a continued steepening of the yield curve, only down about 3 basis points on the shorter end of the curve, a little bit more of a move that we saw on the longer end of the curve, dropping about 5 basis points for your 30-year yield.
All right, guys, I want to get to some of the stories that definitely caught our attention. Matt and I have been talking about this a little already, and I'm assuming maybe a lot of folks in the newsroom, because it was a pretty hot weekend, and so not sure how many people ended up staying inside, maybe watching some stuff because, in their air conditioning. But Squid Game, it's next season coming out on Netflix. Not doing so well. And I got to say, I finally watched the first seasons. I don't know. What season are we in? Are we in 2 or 3?
We're in 3.
I think.
We're in 3. All right. I think I watched the first 2 seasons because my daughter.
The first 2?
My daughter.
How could you, after watching the first one, why would you want to do that to yourself again? What a horrendous
My
experience.
daughter and her friend were like, you've got to watch this. I feel like it's part of our cultural background. And I was kind of.
It was depressing.
It was super depressing, but I kind of couldn't stop watching.
It would have to be 150 degrees out before I would watch this. I mean, I saw the first one because I thought I needed to understand its commentary on society.
Totally.
But I don't need to see that commentary 3 different times. I mean, it was a horrible, horrible experience. What a depressing.
I know.
I mean, why would I want to spend my time doing that?
Did you guys watch? I didn't watch.
I watched the first one. I didn't watch the second one because, just as Matt expressed, I was like, I think I got the message. I don't need it hammered in to me.
Romaine, you have no Squid Game.
I haven't seen
thoughts?
this. I mean, honestly, I'm not a fan of squid. So, yeah, not really my cup of tea.
No squid there.
Not even fried, like calamari or something? I don't know. Squid.
And I'm a conspiracy theorist on that. You know it's not real squid, right?
All right.
You know what it is.
What is it? Octopus?
No. Google it yourself.
Okay.
Or perplexity it or whatever we're saying now these days.
All right. Thanks for the help there. All right, we're gonna wrap.
You're going to be shocked, Matt.
Wait, we didn't. I thought we were going to talk about F1. That's what I care about. I thought you guys were going to talk about F1.
He's really upset. I mean, he
wait till it's available on Apple Plus. We can talk about F1 then.
You have to see it in the IMAX.
That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Original, Scarlett, and Romaine continuing there on TV. Matt and I continuing here on Bloomberg Business Week Daily. He's, of course, in for Tim. We'll see you again, same time, same place tomorrow.
As we get back to business on Bloomberg Television, wrapping up a phenomenal quarter for U.S. stocks amid all of the chaos and big questions about what comes next. A conversation with Jim Bianco when we come back after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Quite a phenomenal quarter, if you will. I mean, we came into this quarter, I think there was a lot of dread, right? This idea that we were headed for some big plunge, and we got that plunge.
Early on, at least.
Yeah, but we also got a big rally out of it, and I think it's kind of fitting that on this Monday afternoon, the final trading day of the month end of the quarter, we do get the S&P 500 moving higher to a fresh record high above that $6,200 level. As far as what drove it today, what else? It was a lot of the big chip stocks, because NVIDIA, Apple getting in on the action. The Philadelphia Semiconductor Index only fractionally higher on the day, but that was the big star of the show for the quarter, a 30% run for that index. And take a look at the second line of your screen. Those are hydrogen stocks. They got a big boost on the day, largely because of an almost 30% run up in plug power today. This on the back of some revisions to that tax bill, Scarlett, that's working its way through Congress, a tax bill that now includes some credits for using hydrogen power.
Yeah, but it's still working its way through, so anything could happen, and all of that could change very quickly. In the meantime, let's take a look at some of the day's biggest movers. We're going to start with Oracle here, gaining 4%. It did gain as much as 8.5%. Nevertheless, this is a record high for the software company after saying it signed a single cloud deal worth $30 billion in annual revenue. It did not name the customer, and we know that the revenue, though, will start flowing in fiscal year 2028. Boeing finishing the day down about 2.3% for the worst performance in the Dow Industrials. UK regulators say that the company's $4.7 billion deal to buy its former spin-off Spirit Aerosystems will now face a UK antitrust investigation. And in fact, regulators will decide whether to either close the investigation or to launch a deeper probe by the end of August. And after the market closed, Boeing also announced it is replacing its CFO. Meantime, our top story this hour, the second quarter is in the books, and for equities, it all ended well enough after a bruising April. The S&P 500 lost 12% in the 4 days after President Trump's across-the-board tariff announcement on April 2nd. Bonds also tumbled, dragging the dollar lower, leading to investors to question whether the American exceptionalism theme had turned into a sell America trade. But then Trump's pause on the tariffs, along with efforts to lower the temperature with China, helped to repair sentiment. And data that consistently shows inflation remains muted has since opened the door to hopes that the Fed will soon resume cutting rates, possibly by 2 or 3 times this year. Romaine?
All right, Jim Bianco joins us right now. He's the president over at Bianco Research. And Jim, the big question I think everybody has isn't so much as to whether the market can keep rallying, but I guess more importantly, the idea as to whether the economic backdrop, and for that matter, the corporate fundamental backdrop, would be supportive of additional gains.
I think it can be supportive of additional gains, but it's also going to come with a offset. And that offset is that that supportive backdrop is going to keep the economy going strong. And that means that the fair value for interest rates is going to be somewhere around 5%. And so that's where I kind of differ with what President Trump has been talking about for the last couple of weeks, in that interest rates are not high. Interest rates are where they should be. And a strong economy and maybe even an uptick in inflation should push them even higher. And that shouldn't be viewed as a problem, but more as an offset to higher stock prices, because it does provide an alternative investment for most people.
This is the idea, and I mean, of course, you know, Jay Powell and the other Fed members will tell you they're not bowing to political pressure. But there is now this sentiment in markets right now that rate cuts are coming, and multiple rate cuts for that matter, over the next, 12 months or so. Is that sort of, at least at its core, viable?
It is at its core viable, but I think that some things have to fall into place in order for it to be viable. And the first one and the big one is going to have to be that inflation continues to moderate. At its current level, inflation is still too high. Yeah, you could argue it's a 4-year low, but it's still higher than anything we saw. I'm talking about core inflation now, higher than anything we saw in the previous 30 years before 2020. But it's got to continue to moderate, and there's plenty of signs that suggest that it might bottom out. And it might start to drift a little bit higher here, into the second half of the year, that would prevent rate cuts. But if it doesn't, then it is definitely viable. Otherwise, you run the risk of what we did a year ago. A year ago, the Fed cut rates 100 basis points. They were too early. The economy rebounded too strong, and long-term yields went straight up. The 10-year went from 3.6 to 4.8 in 3 months. So if you cut rates in anticipation of this fall in inflation and it doesn't happen, you're going to shove the 10-year yield right through 5% if you're not careful.
Jim, one thing we have seen is animal spirits are back. Companies are IPOing and they're going fairly well. We see a spate of deal announcements today, including Home Depot's purchase of another company to really boost its pro contractors business. How much of this do you credit to the absence so far of high inflation, or is it a case of falling yields? What's driving this, optimism, this confidence that things are good?
Oh, I think it was also the clarity that we got after April 8th. Liberation Day, April 7th, the stock market fell 15%, as you mentioned earlier. But then Trump put a 90-day pause in the tariffs. Then we got a deal with the UK. We've got, some rumblings of a deal with China and maybe even with the EU. And there was a lot of stuff that was put on pause or hold during that uncertain period. And now that that's lifting, I think you're starting to see a bit of a catch up with it. Now add into that maybe the outlook for the economy isn't nearly as dire. The talk about, the loss of American exceptionalism was overdone. Yeah, the dollar's down, but not the U.S. economy. So I think you're starting to see a rebound in a lot of those deals.
You call it clarity, though, but isn't it just a delay? Because a pause is not the same thing as rolling them back.
Yeah, clarity in respect that we now know what they're trying to do. We now know that they've got deals on the table. You had Scott Bessent on this morning, and he's talking about dozens of deals by Labor Day. So I think we're going to take that at face value, and we're going to expect dozens of deals by Labor Day. And if we don't, there'll be a big disappointment in the market. And that's the clarity, because when you go back to early April, we didn't know what to expect at that point. We didn't know where we were going with all of this. But a lot of that's changed now.
A lot of that's changed. And so as the market sort of tries to digest all of this, Jim, what is the biggest risk that you're keeping an eye on right now?
I'm an inflationista at heart. I think that the cycle in inflation ended in 2020, and we're in an elevated inflation era. Now that I've said that, I always like to quip, I don't mean 8, 10, or Zimbabwe inflation, but I mean like 3 to 4% inflation. And I'm talking about core, and we're at about 2.8% right now. I think that's the biggest risk, is that we settle in at a 3-ish% or low 3% on the inflation rate. And then the realization is normal interest rates are around 5. And that is what the level that the world we live in. Scott Bessent, again, was on with you this morning, said he would not term out the rates, sell long-term 10-year bonds in order to lock in these rates. He goes, why would I at these levels? The implication is there's something wrong with the bond market, that these levels are too high. But I think that the reality is they're not too high, and that's the risk when we start to realize, no, this is the world we live in, a 5-ish% interest rate world, and then we start to reprice valuations and everything else to that world. We're not quite there yet.
All right, Jim, always appreciate you taking time for us. Jim Bianco, president at Bianco Research. A closer look here at what lies ahead potentially for markets. And as we wrap up the quarter, we take a look at some of the big movers in the quarter. And one of those stocks was not Apple, believe it or not. We're going to use that as an excuse to take a look back in history at Apple becoming the first $3 trillion market cap company. That's coming up next. This is Bloomberg. All right, let's take a quick look back at history, recent history. June 30th, 2023, when Apple became the first company to log a market cap of $3 trillion. It was a long time coming, but to be sure, it was a milestone most saw as inevitable. Apple first became the world's most valuable stock in 2011 when its market cap was only $340 billion. It reached $1 trillion in value in mid-2018 and $2 trillion in 2020. And the stock's $3 trillion close 2 years ago today, while lauded, was for the most part its peak. Apple stock really hasn't gone much further since. Its shares are up about 6% over the past 2 years, compared with a 40% run for the S&P, a near 60% run for the NASDAQ 100, and a near 90% run for the Magnificent Seven as a group. In fact, Microsoft leapfrogged Apple and its $3 trillion milestone back in 2024, and NVIDIA, which had a market cap of less than $1 billion in 2023, has rode the wave of Gensanity to hurdle over both to become the world's most valuable company with a market cap now approaching $4 trillion. It's not really Apple's fault, though. The iPhone maker has endured regulatory scrutiny in the EU, tariff-related stress related to China, and political pressure back home here in the United States. And the stasis in the stock relative to other large-cap names, well, that may not actually change anytime soon. Analysts have actually been trimming their earnings estimates for Apple on account of the geopolitical uncertainty. And barely 60% of the firms tracked by Bloomberg actually recommend buying the stock right now. That's Apple's lowest consensus rating since 2020 and the lowest among the 10 U.S. traded stocks with trillion-dollar market caps out there.
Of course, Apple shares did finish higher on reporting that indicates that Apple is considering using outside AI to power Siri as it tries to shift away from building out its own AI capabilities and perhaps just buying it instead. Now, from one Mag 7 name to another, let's talk about Tesla, closing the day lower, extending its losing streak to 5 days now. This as the CEO, Elon Musk, slammed the Senate's latest version of President Trump's tax bill, warning that cuts to EV and other clean energy credits would be incredibly destructive to the country. Bloomberg News reporter Dana Hall, who covers all things Tesla and Elon Musk, joins us now. Dana, so many people who are Tesla bulls talk about how really the stock is priced the way it is because of excitement over the robo-taxi. But on Wednesday, we get the latest Tesla vehicle deliveries numbers, and analysts are looking for double-digit declines in the second quarter. This could bring the stock back down to earth once again.
I mean, you would think so, right? Because fundamentally, Tesla is in the business of selling cars. But to your earlier point, a lot of the investor excitement is about autonomy and AI and robotics and this future that Elon Musk has painted for his shareholders. But yeah, I mean, we're seeing consensus estimates drift down. And, just in terms of the delta, a year ago in the second quarter, Tesla sold roughly 444,000 vehicles. This quarter, some analysts like Ryan Brinkman of JP Morgan, they're looking at 360. So that's a big, big shift. And it's not just here in the United States. It's, China and Europe as well.
I am curious, specifically for Tesla, is there a lifeline in rideshare and autonomous driving and how that ties together?
Well, I think that, basically, if you think about the way that Elon Musk thinks about it, I would say, is that, Tesla solved the problem of making a highly desirable, affordable electric vehicle. And now Elon Musk is moving on to the next big thing, which is how do you differentiate yourself? And he wants to make a fully autonomous vehicle, and they are on the road to doing that. It's been over a decade in the making. But yeah, I mean, I think Tesla sees a future where fewer and fewer people are actually buying cars, and instead you're buying rides, and they really want a piece of that. And They're doing this very small rollout in Austin, and claim that they will be able to roll it out to other cities across the country. But that is what the investors are largely focused on. So you have this real split in terms of the fundamentals of the auto business, which is somewhat shaky right now, and the future of autonomy, which is what Elon has pivoted the whole company to focus on.
All right. Dana Hall helps cover this stock for us at Bloomberg. And, of course, we will be keeping an eye and have full coverage of the release of those delivery numbers. And we should point out, Scarlett, Tesla did have a phenomenal quarter, up about 23%. Yeah. But we should point out it's having an awful year. It's the biggest laggard in the Mag 7, down more than 20%.
I know. It's a pretty incredible move here. And, of course, it all hinges on that robo-taxi. So when you have a report like the one coming up on Wednesday, it's going to basically be a reality check because the robo-taxi is not a big part of the business right now.
Yeah, absolutely. Well, Tesla is starting to see a little bit of a juice as we got towards the end of the quarter. And so, too, were deals, M&A. We're going to be talking about that when we come back after the break. $1.8 trillion in deals and counting. We're going to talk about what drove the uptick and, more importantly, will it continue? This is Bloomberg. All right, we're going to talk about M&A activity because there is a lot of hope for how 2025 will shape up. Deal making is up sharply since mid-March as CFOs steer their strategies through a sea of macro uncertainty. That's according to a new survey out by Bain. It brought the total value of deals so far this year to $1.8 trillion, and it may not stop there. Nina Trentman joins us right now. She works for us here at Bloomberg, and she covers all of this in the weekly newsletter CFO Briefing. Nina, great to have you here.
Thanks for having me.
So what happened? Because somehow on the way to complete catastrophe in the deal space, we somehow found a way to not only do more deals, but actually do more deals at higher valuations. What's driving that?
Yeah, that's a good point.
Yeah.
I was going into this year thinking that wouldn't be happening. And of course, April seemed to confirm all of that when deals stalled. The interesting thing is, as you pointed out, that deals actually have been picking up quite substantially compared to last year. We have seen deals in various sectors take place, and CFOs are actually saying, yes, of course, there's a lot of noise, and we are aware of the tariffs, but also we'll resolve them one way or the other. And so we're basically pushing through with deals. Not necessarily, though, in the industrial sector, where deals are down 15%, not surprisingly. But in many other areas, people are saying, OK, well, we'll need to move on with things.
What do these deals look like? Are we basically just talking about more sort of like vertical integration? Are we looking at more speculative type deals? Like, what's getting done?
We've seen a range of deals come through. So, of course, we've seen technology deals driven by companies' need and want for AI because they're realizing, OK, there's no way that this technology is going to go away. And then we're also seeing companies adding to their portfolios. For example, Merck, the German pharmaceuticals company, I spoke to them last week. They acquired a U.S. asset and said, well, the dollar is actually helping us quite a bit. They were saying because of biotech assets being trashed, because of valuations coming down, now is a good time for them to buy in the U.S. And of course, we'll see if that continues with the dollar basically dropping by the day. Plus, of course, there's also other considerations that are driving deals. We saw Salesforce, for example, pursuing Informatica. Last year, that deal didn't happen. This year, they got it for, I think, nearly a 30% discount compared to last year's value. So it's a mixture of things.
And we've had others. You had the Charter deal for Cox and a few others, Alphabet. And then there's also I think it's interesting, some of these deals that aren't, I guess, really deals. I guess they're deals, but they're not really acquisitions. This idea of sort of maybe just buying, 50% or maybe just below whatever the controlling stake would be as a way to sort of get entry. I don't know if that's for financial reasons or if that's to avoid regulatory scrutiny or what.
Also, I think a mixture. Of course, in some ways, it's also companies getting their first foot in the door, so to say, by saying, OK, we're acquiring a stake of 10, 20, 30, 40%, and then also seeing how it goes from there. Plus, also, what we're also hearing is that divestitures, that it's a good market for that as well, given that companies are looking at their portfolios and thinking, well, is this asset really what I want to keep, given that they're expecting more uncertainty to come with Trump in the White House and tariffs to continue.
All right, really interesting study. It's in the latest CFO newsletter that Nina Trentman helps to manage here. And you can sign up for Bloomberg's CFO Briefing, a weekly newsletter for and about CFOs featuring top executives at global companies and covering key trends in corporate finance. There's your plug, Nina. All right, we're going to keep the conversation going because more than half of this year's biggest deal have zeroed in on private targets. That includes Charter & Cox. It includes Apple's purchase of cybersecurity company Wiz, and it's a testament to the growing interest out there in private markets and a big question as to whether that continues deeper into 2025. Bill Curtin joins us right now. He's the global head of M&A over at Hogan Lovells. Great to have you here.
It's great to be back, Romaine.
All right, so you must be sitting pretty. I think we only spoke maybe a couple of weeks ago, and you were relatively optimistic there. It's interesting to actually see some actual hard data and some survey data basically ratify what you said, which is that there is a lot more optimism about getting deals done. Why?
Well, you're right. I'm sitting a little bit taller in the chair today because we've got this surge that we anticipated just a few weeks ago. And I think people can now see that time period I mentioned, Romaine, which is September. It's not that far away. We've got a little summer break here. We want the tariffs to settle down. We're going to see if we get an interest rate cut in September, right? And we've got consumer sentiment holding pretty well. The story really, as Nina and you just discussed, is that the surge we're seeing is in the value side of the proposition of deals. So bigger ticket transactions are getting done. They're up 30% year on year. The number of deals that are getting done is getting better too, but it lags. We're still year on year down 11% on the volume of deals. But the value indicator for the deals that need clearance under regulatory, as you said, regulatory scrutiny, they're moving forward and getting done.
Well, let's talk about the regulatory scrutiny. I mean, a big promise of the Trump campaign when he was on the road last year was this idea that you would have a regulatory environment that would be more favorable, or at least more favorable than the Biden administration. So far, they haven't really done anything, but that actually might be the deregulatory nature of it all. They're not really standing in the way of anything, are they?
They're not, and they have a different approach. So in the preceding administration, it was a binary result. You brought your transaction to the authorities, and you got a yes or you got a no. And the no often came with a present attached in the form of litigating against the United States of America, which most people don't want to unwrap that present, right? Now we're in a circumstance where it's either a yes, or if it's not a full-on yes, it's a modified yes with some conditions. They can be structural remedies or behavioral remedies. And parties can deal with those circumstances because ultimately their transaction gets cleared and they can move forward with their agenda.
So is this idea, though, as they move forward with that agenda, and when you talk about the size of these deals, the value of these deals, I'm curious about the function of that. Is that just because these companies are flush with cash or high stock prices to be able to fund it, or is that also tied to the regulatory aspect, the idea that a big mega deal probably would not have even seen the light of day just a year and a half ago?
You're right on both counts. It's both counts. We have an extremely resilient American economy. Think of all the things that are in the face of it. We've had geopolitical issues. We've had uncertainty in the executive. We've had discordance between the executive and the judiciary. And we've had tariff imposition like we haven't seen in our business lifetimes, right? So we've had a very resilient economy with very stout balance sheets on the corporate side. And now we have a DOJ and FTC that give us that special ingredient we need for M&A, more predictability. That's what we need to move forward.
Before we move on, though, I am curious, though, about this idea that if you do a deal in this space that gets past the regulatory scrutiny, or there isn't regulatory scrutiny, and you do end up with a new administration in 3 years, that let's say a Democratic administration that does want to take a more aggressive approach, does that put the deals that are done in jeopardy, or is that just kind of it's done and they can kind of move on?
It's the latter. Those deals get done. Then they go to some of the hard parts, which is the integration. On Bloomberg, you do such a great job of announcing Merger Monday or these other big events. Then there's this period of time afterwards for post-merger integration, as we call it, which is very hard work. But those are not susceptible to rescission. Those transactions get done and we move on and we bring a new administration in with its predictability or unpredictability. What's really interesting in M&A, Romaine, is folks aren't particularly wedded to a type of outcome as much as an awareness of what the outcome will be. We're remarkably adaptable in the M&A community, these corporates and these private equity firms. They're incredibly elastic in the way that they can make deals and transact, but they have to believe that they have visibility on outcomes, so they know where things are going. So it's really both.
It's interesting. So we talk about the number of companies that were bought that were private. So basically a public company going after a private. And based on at least the data that Bloomberg has, as well as the data that Bain has, that's an increase from what we've seen in previous years. Is that sort of a function of this sort of pent-up pipeline of private companies that maybe didn't find a path to either the public markets or to M&A a year or two ago?
It is. It is for sure. And we've got a circumstance now where we're getting pretty far along in the tariff imposition. So I think we need the whole summer to really see how that plays out, right? But we haven't had a significant inflationary response to that, right? And so companies are adapting and pushing those costs through pretty well, right? And alongside that, you have this pent-up, these strong corporate balance sheets, a lot of dry powder with the private equity firms, the sponsors, right? And so when you put just enough predictability alongside a very resilient and healthy, in its fundamentals, business community, amidst the overlay of the technology imperative, transactions happen.
So the one interesting nugget, and it didn't really show up in the data, is this idea of cross-border transactions. Obviously, probably the most famous one, at least in recent months, has been the Nippon Steel deal. That might be a deal, might not be. But I do wonder that we talk about a lack of regulatory scrutiny. One thing this administration has made clear, there is certainly a lot of geographic scrutiny with regards to how foreign countries and their companies are dealing with the U.S. If someone rings you up and says, hey, a U.S. company, and says, I need some advice, we're interested in this Japanese company or this European company, or they're interested in us, do you just tell them not to do anything, or do you say, yeah, maybe it can get done?
Well, I say we have to look at that very carefully, more carefully than we have in the past. Nina and you were right on the commercial side to look at the weakening dollar. On the deal-making side, you're right to think about what we call FDI, foreign direct investment. Traditionally, it was a U.S. proposition through our Committee on Foreign Investment in the U.S., the CFIUS. Now you see foreign direct investment regulatory regimes all over the world, Romain. And so we, as an imperative, look at that with our clients on the front end. And again, we try to be as predictable as we can on two things. Outcome, will you get approved, and the amount of time it will take to get that approval for your transaction overseas.
Are there certain industries where you're seeing, or maybe anticipating, I should say, more activity than the others?
Yeah, I think defense is a very logical one now, right? I mean, I think we know now there's going to be significant transactional activity in the European defense theater, right? With the increase in the budgets and the need in the acute term, right, for more defense comfort across the European arena. Of course, the Middle East circumstances, right? And then we still have North Korea, we have China. So this is a world that is fraught at the present. And that's why I think it's remarkable how resilient these corporations and private equity firms in the American economy. I'm not one of those who says that American exceptionalism is a retired notion in commerce. I actually think it's quite extraordinary the way that America has persisted. Almost half of the M&A that's conducted in the world emanates from the United States of America.
Yeah, I can believe that. All right, Bill, we have to leave it there. Always great. Bill Curtin, one of the best in the business, global head of M&A over at Hogan Lovells. All right. Let's take a look at how the market closed here on the day, and more importantly, in the first half of the year. You're taking a look right now at the year-to-date moves on the S&P 500, up about 5%, and that includes a more than 10% move that we saw in the most recent quarter. The NASDAQ up about 8% on a year-to-date basis. And you take a look at the yield there on your 10-year yield down, but more importantly, on a price basis, you're having one of the best starts to U.S. Treasuries since at least 2020. We'll be back in a moment. This is The Close on Bloomberg. All right, it's time now for our top three. This is where we name drop the people driving some of the day's most talked about stories. And we start with legendary short seller Jim Chanos. He's warning that the AI ecosystem is close to a potential pullback, much like the dot-com bubble of the 1990s. He adds that signs of a slowdown in the labor market and potential disruptions from tariffs could force corporate customers to cut back on their spending plans once again. We're also keeping an eye on Ken Griffin. The billionaire just bought one of the most significant documents ever signed by President Abraham Lincoln, a record-breaking bid of $13.7 million for a handwritten copy of the 13th Amendment. This was at a Sotheby's auction. He also won a rare copy of the Emancipation Proclamation that he bid $4.4 million for. And rounding out our top three today is the U.S. Treasury Secretary. Scott Bessent joined Bloomberg today, and he had this to say about the current state of tariff negotiations.
We have countries that are negotiating in good faith, but they should be aware that if we can't get across the line because they are being recalcitrant, then we could spring back to the April 2nd levels. I hope that won't have to happen.
And for more of where we stand in the tariff trade, if you will, Emily Stromquist joins us. She's Managing Director of Political Risk at the advisory firm Teneo. All right, Emily, I know we're still a little ways to go before we get to July 9th, and there's a lot of uncertainty about what could get done before then, what might not get done. But I am curious, when you look at the progress or lack thereof since Trump sort of made these ultimatums with regards to getting a deal or at least a memorandum of understanding, do you think we are going to have enough on the table and signed by the time we get to July 9th?
No, Romaine, I think it's very hard to say. We are starting to see some momentum and progress being made, whether it's China with the concessions on rare earths or Europe starting to accept the 10% base rate, Canada just, starting to back off on digital services tax. So we're seeing these signs and cues that countries are preparing to negotiate. They're putting forth their positions, but we're a far away from sweeping tariff reform. This is certainly boosting market sentiment, but we're not quite there yet in terms of the sweeping reform that has been discussed.
Well, that's what I am curious about, the potential volatility between where we are now until we get to a deal. And we always have to remind viewers that a real, true trade deal is going to take months. And most likely what we get, if we get anything by July 9th, are just going to be more just agreements to agree in the future. And I do wonder, what's the message that you give to people in the C-suite who are trying to plan, whether it's buying inventory, whether it's finding ways to export whatever it is they're making, or just dealing generally with cross-border transactions? What do they do in the interim? What do you advise them?
Yeah, so we are seeing a lot of companies that are starting to feel the pressure about the uncertainty that all of this means. And I think coupled as well with a lot of geopolitical uncertainty in the market, we're seeing a lot of need to do strategic decision making. Teneo has actually just published a new CFO and institutional investor survey. In that, we spoke to several hundred different participants. And I think what was interesting is across the board, you see very mixed sentiment about the outlook for the global economy and particularly the U.S. economy. But a resounding takeaway from our survey was that 86% of CFOs are looking to reshape their supply chains. They're looking to consider or reconsider key CapEx decisions, manufacturing hubs. So we are seeing these kinds of decisions across our clients and across the market being taken to sort of fortify businesses and to ensure that they're prepared for sort of any number of outcomes in terms of tariff negotiations.
We were speaking right before you with one of the top M&A advisors out there, and we were talking about this idea of the increase in M&A activity and how CFOs seem to have a little bit more confidence in getting those deals done. But is there a risk that maybe the decision ends up being wrong? Not so much because they made the wrong decision, but because of how much can change with regards to White House policy and its direction?
I think certainly. I think any volatility in policymaking, the way that we've seen tariff negotiations unfold so far, that certainly creates some risk for that decision making. But I think, the more diversified supply chains are, the more sort of options there are to be able to move manufacturing, to be able to fortify, to be able to kind of prevent any sort of worst case outcomes. We're seeing companies doing that, and that should help to manage some of that volatility for sure.
The other big risk out there amongst the multitude of risks that these executives have to navigate is, of course, the military issues, whether it's the conflict in the Middle East between Iran and Israel, the issues going on in Gaza, and of course, the still ongoing Russia-Ukraine war. How much of that becomes a potentially fundamental factor for these companies?
Yeah, I think on top of trade and tariffs, that's still the big issue that's really driving concerns about supply chains and about how to think about the market. We've not seen a lot of focus on the Ukraine issue right now, but we just got the 5% spending commitments across NATO. That's certainly going to cause some sort of additional interest in what's happening on the Ukraine front. I think in terms of Iran, there's a ceasefire that should hold for now, but there's some clear red lines that can't be crossed. And if they are, that can create a whole new issue again, and things can flare up again in the region. So I think, it's really these are the kind of key hot spots that everyone's watching. And, in particular, in the case of Iran, we've seen very mixed reports about where things stand at the moment. So, if we see Iran moving toward a nuclear bomb again in the coming months, that could be a whole new sort of issue that investors are going to be concerned about all over again.
Yeah, we saw, of course, that big spike in oil after the first salvo by Israel. Nevertheless, we actually seeing crude prices back down, at least here in the United States, below $65 a barrel. Still elevated from where they were at the start of the month, but not nearly the sort of the $100 and $100+ levels that I think were starting to freak out some folks. Do you anticipate that we'll see a little bit more stability in energy prices? Basically, where they are now might be where they are months from now?
Yeah, I think that's right. There's probably about a $10, give or take, risk premium that's in the oil markets right now. We saw that come off quickly after the ceasefire was announced. I think one of the biggest issues with the oil price right now is that we're looking at, give or take, 4 million barrels per day of capacity, but most of that rests with Saudi Arabia and with the UAE. If the situation flares up again, that introduces a considerable new risk that we could see prices shoot back up quite quickly. So I think the fact that there's sort of so much concentrated volume coming online in that region is a huge concern for oil prices and for oil markets. But the fact that we have so much new production that's coming online from outside of OPEC, from North America, from Latin America, this is certainly helping to keep a cap on prices at the moment.
All right, Emily, always appreciate you taking time. Emily Stromquist is Managing Director of Political Risk at Teneo. And of course, we are continuing to keep an eye on Washington as that tax bill continues to work its way, or tries to work its way through the Senate. When we come back after the break, we're going to set you up for what the markets will have their eyes on over the next 24 hours. Stick with us. This is Bloomberg. All right, here's what the markets are going to have their eyes on over the next 24 hours. And we start off with a lot going on when it comes to monetary policy. We're going to hear from ECB President Christine Lagarde. We're also going to hear from Fed Chair Jerome Powell. And we're going to hear from BOE Governor Andrew Bailey. They're all speaking with our very own Francine Lacqua at the ECB Forum on central banking in Central. We will have, of course, full coverage right here on Bloomberg Television. At 9:45, we're also going to get some interesting manufacturing data. This out of S&P Global. This is the final read for the month of June. But then at 10 a.m., about 15 minutes later, we're going to get the first read from ISM. The ISM manufacturing data is expected to basically hold right around 48, where it has been in contraction territory. On top of that, we're also going to get JOLTS data, which is expected to show that when it comes to job openings and layoffs, that also is holding right around where it has been. We do get some earnings as well, including from Constellation Brands. And the Philadelphia Fed has a new president starting tomorrow. Anna Paulson will taking over for Patrick Harker, who's stepping down. That does it for us here at the close. Balance of Power is up next.